You know that saying, a billionaire won't bend over for a $100 bill?
Yeah, I've heard that one.
Well, it's not really about being lazy. It's apparently because, standing still, they're actually making more money per minute than that $100 represents.
Quite literally. It's a fascinating, kind of jarring thought, actually.
It really is. And it's more than just a witty line. It's like a tiny window into this hidden system of wealth that, frankly, most of us never see.
Let alone get to use.
Exactly. So today, on the Deep Dives, we're going to pull back that curtain. We really want to understand how this all works.
Yeah, let's get into it.
Our mission here is to unpack what we're calling the wealth strategy that beats taxes. How the rich turn paper into power.
It sounds almost like alchemy.
Doesn't it? But it's real. We're talking about a financial playbook, really, designed for people who own assets. And at its heart, it seems to boil down to 3 moves. Surprisingly simple, maybe. Buy, borrow, die.
Buy, borrow, die. Okay.
Yeah. We're going to try and reveal how the ultra-rich legally navigate around the financial rules that pretty much everyone else has to follow.
Okay, so where does it start? I have to begin somewhere, right?
Well, it seems like it starts with a really fundamental difference in how wealth is even thought about, how it's generated, and how it's treated by the tax system.
Right. So for most people, the focus is income. Your paycheck, you earn it, you spend some, maybe save a little bit.
If you're lucky.
If you're lucky, yeah. But that income, especially if you're a high earner, say, in the U.S., it gets hit hard with taxes right away.
Instantly.
Yeah, you could be looking at, what, over 35% combined? Federal, state, payroll taxes. It adds up fast. It's this cycle, almost like a treadmill for a lot of folks.
It definitely feels that way sometimes. And this is exactly where the wealthiest individuals just flip the script entirely.
Just so.
Instead of focusing on generating, taxable income, their main game is ownership.
Ownership, okay.
Think about the big names, like Musk or Buffett or Zuckerberg. What are their official salaries?
Tiny, right. Sometimes like $1 a year,
Yeah.
symbolically.
It's symbolic. Their real wealth isn't in some weekly paycheck. It's tied up in billions of dollars of equity. Shares in the companies they built or invested heavily in.
Right. The value is in what they own, not what they're paid as salary.
Precisely. And that equity grows and grows, hopefully. But here's the kicker. As long as they don't sell it, they don't pay taxes on those gains.
So it's not just a loophole. It's like the core principle.
It really seems to be. It fundamentally separates their financial reality from, well, most other people's. It means their wealth can just compound, tax-deferred, sometimes for decades.
Yeah, and that brings us to this really crucial legal point.
Yeah.
You only owe taxes on gains when they're realized.
Meaning when you actually sell the asset.
Exactly. So let's say you bought $1 million worth of stock.
Yeah.
And maybe it grows to $5 million.
That's a problem I have.
Definitely. But that $4 million gain, it's just on paper. It's unrealized until you hit the sell button.
And until you do.
No tax bill. Zero. It just sits there growing.
And this isn't just for stocks, is it? It applies elsewhere too.
Oh, yeah, absolutely. Same principle works for things like real estate. You could buy a property for, say, $200,000. Maybe it appreciates over many years to $1 million.
Wow.
That $800,000 gain. Untaxed. As long as you hold on to the property, the super rich are, well, masters at holding on to these unrealized gains.
Which inevitably makes you, the listener, ask the big question.
Yeah.
Right? If they never sell this stuff,
Yeah.
how do they actually live?
Yeah. How are they funding the jets, the yachts, the big donations we hear about? Where's the cash coming from?
Exactly. How do they turn that paper wealth into actual spending power?
Right. And that's where the second part of the strategy kicks in, the borrow part.
Ah, okay. So they don't sell, they borrow.
Precisely. They typically don't sell those appreciating assets to get cash for their lifestyle or, new investments. What they do instead is use those assets, that massive stock portfolio, the prime real estate, as collateral.
Okay. So they go to a bank.
Usually a private bank, yeah. Imagine someone rolls in with, say, $100 million in diversified stocks or property. The bank looks at that and sees incredibly safe, stable collateral.
They're probably pretty happy to see them.
Oh, absolutely. They're eager to offer what's called a line of credit. And because the collateral is so good, the interest rates are incredibly low, like maybe 2 or 3% sometimes, much lower than, say, a credit card or even a typical mortgage.
So a line of credit, that's like a flexible loan, right? The bank approves a certain amount, but you only pay interest on what you actually use.
That's exactly it. They get access to this pool of money secured by their assets, which are hopefully still growing in value. And here's the crucial part.
It's a loan, not income.
Bingo. Because it's borrowed money, it's not taxed as income, so this loan becomes their spending cash.
For whatever they want. Lifestyle, new investments.
Anything. They can use it to live lavishly, pour it into new ventures, even buy more appreciating assets. It's kind of brilliant in a way.
Because they're spending millions, maybe, but their main assets are still growing.
And they haven't triggered a single tax bill on those gains because they never sold anything.
Wow. That's a staggering difference compared to how most people operate.
It really is.
I mean, let's contrast that. Think about the average household. When we take out loans like a mortgage for a house, a car loan, student loans,
Yeah.
we're usually borrowing against our future income, what we expect to earn, not against a pile of assets that are already growing.
Correct. And every single payment you make on those loans, it comes from money that's already been taxed.
Right. Your paycheck gets taxed, and then you use what's left to pay back the loan plus interest.
Think about a mortgage. Maybe $250,000. With interest over 30 years, you could easily end up paying back over $500,000.
Easily.
And that entire $500,000 came from income that was taxed before you even got to make the payment. It's like a double hit, in a way.
Yeah, taxed income paying off debt. Ouch.
And for the average person, let's be honest, the bank holds most of the power in that relationship. You miss payments.
They can take the car, foreclose on the house. You don't really own it free and clear until it's fully paid off.
Exactly. But for the ultra-wealthy using this borrowing strategy, it's a totally different dynamic. They're often borrowing a relatively small percentage against their total wealth.
So the loan-to-value ratio is really low.
Extremely low, which makes them incredibly low-risk borrowers in the eyes of the banks. So banks actually compete for their business.
Offering them better terms, lower rates.
Absolutely. Lower rates, more flexible repayment schedules. It really boils down to a simple principle. The more secure collateral you have, the more the financial system bends over backwards to work for you, not against you.
So it's less about the bank trusting the person and more about the sheer safety of the collateral they're offering. That gives them huge leverage.
Precisely. Leverage for incredibly favorable terms.
This whole system really does seem designed to keep wealth concentrated and growing across generations, doesn't it?
It certainly has that effect.
Which I guess brings us to that final, maybe slightly morbid sounding step, die.
Right. It sounds stark, but even death is factored into this strategy with, well, remarkable financial efficiency.
Okay, how does that work? Let's go back to that Apple stock example. Someone bought it for $1 million. Now it's worth $10 million.
Yep. Now, if they sold that stock while they were alive, they'd face capital gains tax on that $9 million profit. Depending on rates, that could be a hefty tax bill.
Millions, potentially.
Right. But here's where the financial planning, let's call it, gets really interesting for the heirs.
Okay.
If those assets are never sold during the owner's lifetime and they're passed on when they die, something called the step-up in basis happens.
Step up in basis. What does that mean?
It means the IRS basically resets the cost basis of those assets. They reset it to whatever the market value was on the date the original owner passed away.
So for that Apple stock worth $10 million.
The heirs inherit it with a new cost basis of $10 million.
Wait, so if they turn around and sell it the next day for $10 million?
From the IRS's perspective, their cost basis is $10 million, and they sold it for $10 million. So the taxable gain is?
Zero.
Zero. No capital gains tax due on all that appreciation that happened over the original owner's lifetime.
That is incredible. That wipes out potentially decades of gains for tax purposes.
Effectively, yes. And this isn't just for stocks. It applies to most appreciating assets. Real estate, closely held businesses, art collections, you name it.
Wow. So vast amounts of wealth can just transfer to the next generation with very little, maybe even zero, tax owed on those built-up gains.
That's the power of the step-up in basis. It's a cornerstone of generational wealth transfer for the very wealthy.
And what about those loans they took out? Do the heirs inherit the debt too?
Good question. Often there's planning for that too. Many wealthy individuals use things like life insurance policies, often held inside specific types of trusts. And the payout from that life insurance upon their death is used specifically to pay off any outstanding loans tied to the assets.
So the heirs get the assets free and clear, no debt attached.
Exactly. They receive clean, unleveraged assets with that stepped-up basis, allowing the family fortune to continue growing pretty much uninterrupted. The whole transition is designed to be seamless.
Okay, let's try and recap this whole buy, borrow, die strategy quickly. It's quite a lot to take in.
Yeah, it is. But the core moves are clear.
Right. So first, buy. The focus is always on acquiring assets that appreciate, that grow in value over time, not just piling up cash.
Correct. Ownership is the name of the game.
Second, borrow. Instead of selling those assets and paying taxes, you use them as collateral to borrow money at very favorable rates. That borrowed money is your cash flow, and it's not taxed as income.
Right. You leverage the assets without liquidating them.
And finally, the end game. Die. You hold on to those appreciated assets until death, the step-up in basis rule that allows your heirs to inherit them at their current market value, effectively erasing the taxable gain that built up over your lifetime.
And any loans are often cleared by life insurance, leaving the assets unencumbered for the next generation.
So what does this all really mean? When you step back and look at it, what's the big picture here for you, our listener?
Well, I think it profoundly shows that the rules of money, they really are fundamentally different depending on whether your wealth comes primarily from income or from owning assets.
Yeah, it seems like two different universes.
For most people, income is tied directly to taxes and often to debt used for consumption or non-appreciating assets. It's that cycle we talked about. Earn, get taxed, spend, borrow against future taxed earnings.
The treadmill.
The treadmill. But for the ultra-wealthy playing this asset game, ownership equals power. It equals financial freedom. It means accessing wealth without triggering taxes and passing it on efficiently.
So it's really not just about working harder, is it? Or even just earning a higher salary, though that helps. It's about understanding and, frankly, using the system.
Exactly. It rewards leveraging assets, not just leveraging your own labor or time for a paycheck. It's about making your money work the system for you.
Which leaves us with a pretty big thought to chew on, doesn't it?
I think so.
Considering everything we've just unpacked in this deep dive. What does this reveal about the fundamental, almost structural differences in how wealth is actually created and maybe more importantly, preserved across different economic levels?
And kind of following on from that, what might be the broader implications for things like economic mobility, for social fairness, when the system itself seems built on these, well, diverging sets of rules?